Welcome to Grand Wealth's second quarter investment update video. I'm here with Calvin Wiersma. He's a member of our investment team and he also chairs our investment committee. I know it's the second quarter or starting the second quarter. It doesn't quite feel like it. It's been a long, hard winter in Michigan, at least.
The roller coaster of spring.
Yes, but I know that you escaped and spent a couple of weeks in the Southern Hemisphere on a sabbatical. So hopefully you're fresh and can carry the energy today.
Yeah, my wife and I had a chance to visit New Zealand, and that was an awesome trip. But yeah, glad to be back and glad to see spring in Michigan. It's always a special time.
So it was a quiet quarter until it wasn't.
Right.
I think for a lot of people, the conflict in Iran is top of mind right now. I want to kind of set aside any, human cost and impact, which is obviously a real thing, and also any sort of political bents that people might have, and just kind of talk about, more at just the economic, finance, and market level, some of the impacts there today.
Yeah.
And so I know for a lot of people, the recent volatility stemming from the conflict in Iran, the energy disruption, that's kind of top of mind. So could you kind of just summarize in a nutshell, what has the impact been on financial markets from that? Where has that kind of landed us at the end of this first quarter?
Yeah, so it certainly was a shock, and I think that markets reacted accordingly. Just at the end of February was when this conflict started. Through the end of March, U.S. stocks were down about 5%. Emerging markets were down a little closer to the 10% range. So there definitely was a reaction in the stock market to the conflict, and especially, to the reduction of the flow of oil coming out to the rest of the world from the Middle East. And I think that's the primary economic concern, at least, is the price of oil going up past $100. But, we're always trying to think about the bigger picture, the long term. And even if you just look at year-to-date performance, while the last 4 weeks have certainly been painful, the year-to-date returns really are not nearly as bad as you might think if you were just reading the headlines. U.S. stocks are down a couple, 3%. Emerging markets, international, pretty much flat. Bonds are down, 0 to 1%. So it's really, if you have a well-diversified portfolio and you have not made any knee-jerk reactions, you're pretty much where you started the year. And if anyone has a memory of what happened last year, it was a really good year, and so you're still doing pretty well.
Yep. So you mentioned about 5% pullback on the U.S. side after the conflict started, 10, 11% for international markets. How, putting it in context historically, how big or small of a pullback is that compared to what you might see in a typical year?
It certainly feels big, but in reality, over history, we kind of average about 5 times a year in the U.S. stock market. There's a 5% pullback, and it's pretty typical once every at least a couple of years to have a 10% pullback sometime in the year. So experiencing these things is really, really normal. It certainly in the moment doesn't feel great, but it's part of what happens in the stock market. And we don't necessarily know when these disruptions come, which is why we don't try and time them either, because we know they happen somewhat frequently and we can't predict it.
Yep. Conversations that we have with clients, especially around this time of year, end of a quarter, tax filing going on right now. What would you say, given the volatility that's going on, to somebody who maybe got, a larger tax refund and is thinking about, is now the right time to be investing that, whether it's a Roth IRA contribution or something larger, or someone who's maybe getting, quarterly distributions if they're a partner or own a business?
Yeah, I mean, there are a lot of ways to look at it, and I'll be interested to hear your thoughts too. A little bit, it's like you can use it as a sort of a psychological motivation to say, hey, this is a decent time compared to a month ago to make that Roth IRA contribution or add other funds to investments. What are your thoughts on that?
Yeah, I think it depends on the size, and then also, is this a regular thing for the investor? Is it a sort of one-time thing? So if it's something that happens frequently, quarterly distribution that they're getting in a pretty predictable way, or a tax refund that's in sort of a normal range for them. Yeah, going ahead and making that Roth IRA contribution now, a solo 401k contribution maybe, I think that makes a lot of sense, or a contribution to a taxable account too. If it's something that's larger, right, a business sale, a really large bonus that's different than what they would normally receive, a lump sum pension cash out, something like that,
Mm-hmm.
that's where we would maybe talk about, how does this fit into your overall financial picture? Does it make sense to spread the risk a little bit by just putting a plan in place and setting a certain amount each month or each quarter
Mm-hmm.
that we're going to be investing, and then sticking to that, barring some really large unforeseen change in market circumstances.
Yeah.
And to your point about it feeling a little bit better psychologically, if you look at the numbers too, right? I think we've shown this chart before and talked about it. Current valuation, price to earnings, is a really bad predictor of what's going to happen in the next year.
Yeah.
But if you pull back and you look at 5 to 10-year time frames, the lower the valuation at which you're investing, on average, the better your next 5-year, 10-year return is going to be. So to
Mm-hmm.
that point, it hasn't been an absolutely massive swing. It's been relatively minor in the grand scheme of things. But if the price to earnings is coming down from, let's say 21 for the S&P 500 to 19 point something, again, you're moving down that
Mm-hmm.
line of what's the PE right now, and hopefully increasing that long-term return that you can
Yeah.
see from investing now.
Yeah, that's a good point. What about if there's an expense coming up? I know sometimes our clients have to make tax payments, or they just, kind of have that goal in mind of maybe it's property, purchasing a property or going on a big trip. What do you tell clients for managing funds for those expenses that are coming up?
Yeah. One, we try to kind of think about it in advance, right? And
Mm-hmm.
if there's a major known expense in the next 12 months, maybe next 18 months, if it's really large, we probably talk about setting aside funds to support that goal
Mm-hmm.
in a short-term or stable investment
Yeah.
solution than the stock market. Um, but right, you don't always know what your end of year tax bill is going to be. Things happen throughout the year. So in that situation, I would say, again, if you look back at the start of the year, compared to January 1st, we're relatively flat, maybe down a couple of a percent in a diversified portfolio. And if we look back a full year, you've actually done pretty well having that money invested rather than being set aside, which isn't an argument to say go take a bunch of risk, invest
Yeah.
every dollar that you have, and don't set aside money for expenses. But I wouldn't feel bad about pulling from a portfolio to pay for these expenses, versus having set aside money 6 months or 9 months ago, because you've actually, at this point, still come out ahead in the end.
Right.
So that'd be the first thing that I would say is, I wouldn't feel like now is the worst time ever. You're not selling at the bottom. And
Mm-hmm.
also, at least we're pretty mindful when working with clients to pull cash out of portfolios on how we do that. So we filter it through, the tax lens of where are we going to not realize a bunch of gains if possible to avoid the tax impact of that. But also we'll look at, what are the parts of the portfolio that maybe aren't beaten down over the last month.
Yep.
Bond market's down 0 to 1%, like you said. That's
Mm-hmm.
a place to pull some funds from. Real estate's actually up slightly. Maybe that's a
Mm-hmm.
spot to pull some funds from. We'd kind of apply those filters and look very specifically at what's the best way to raise this. And we wouldn't shy away from, or, push them to go look at, funding with debt, for
Yeah.
example, to make a payment right now versus pulling from their portfolio.
Helping investors help themselves, keeping funds they need for a known purchase in cash can be a nice way to kind of ride out the volatility that they might be seeing in their portfolio, knowing that they don't have to liquidate something potentially at the wrong time to, pay taxes or buy the piece of property that they've had their eye on.
So shifting a little bit away from current events, you've written in our quarterly newsletter
Yeah.
about small cap stocks. What has their historical return been relative to large cap stocks? It's obviously part of our investment philosophy is a little bit of a tilt to small cap
Yeah.
stocks. So could you just lay out kind of what you wrote there when we look back over the last 50, 100 years? what have returns look like for small cap versus large cap stocks?
Yeah. So as you mentioned, part of our investment philosophy, there are kind of two pieces that I would highlight. One is we believe in efficient markets, and what that means is that all the information available publicly is priced into prices, almost instantly these days. So there's no way to really, um, you know, find a new corner of the market that no one has discovered before and get excess return. You get rewarded for taking on uncertainty. And the more uncertainty you take, the more return you get. Just like, when stocks have higher returns than bonds because your investment is at risk versus bonds paying an interest rate and then eventually paying you back the principal.
Mhm.
The other thing is, we really believe in looking at the historical data and evidence to drive how we approach making investment decisions. And so that's where the small caps come in. History in the US and all global stocks have really shown that small companies, sometimes referred to as small caps, have provided about 1.5, a little over 1.5% annual return in excess of what the S&P 500 returns in the US. 100 years of data has shown that extra return has been consistent for small caps. And then, as I mentioned, it's actually even greater excess outside of the US. So if you're investing in international developed or emerging markets, you get an even bigger premium for making those investments in small companies.
Yep. Which, tying back to your point about risk and return,
Mm-hmm.
you'd intuitively kind of expect that, right? Because if you're already taking additional risk on as an investor, probably going into an emerging market where there's going to be more volatility,
Mm-hmm.
in the smaller company size in the emerging market, there's going to be additional risk beyond that, which is why we wouldn't put a huge amount of a portfolio specifically into that because
Right.
the risk would be too great. But over a really long time period, you would expect by taking on more risk that you're
Yeah.
going to be rewarded with a higher return, again, over a very long period of time.
Yep.
Thinking about recency bias, which I think you also
Mm-hmm.
mentioned in the newsletter. So, kind of that tendency of people to over-index on or, look at what's happened recently and, overweight the likelihood that the near future is going to look like the recent past. How, do you think that's factoring into the way that people look at investments in large cap versus
Mm-hmm.
small cap? And, what's the risk there? Or how would you respond to someone saying that, well, large caps have done better the last 5 years maybe than small caps?
I would respond and say, yes, you're right. In the US in particular,
Yep.
large caps have definitely beaten small caps recently. But again, when you look at the data, that extra return shows up for people who are invested over long periods of time, so 10, 20 years. A lot of our clients are investing for 50 years. It's not making decisions based on what has worked lately, but looking at the historical trends, the historical data, and making informed decisions based on the evidence. But even just, in the last 12 months or so, I pulled up a chart that showed the Magnificent Seven return for the last 12 months and compared it to the Russell 2000, which is an index of small companies. And the returns are really, really close. And so even though the headlines are all telling us, hey, it's been NVIDIA, it's been Microsoft, it's been Google, those are the companies to own, we, again, just pulling back and looking at the data and seeing what has actually occurred, and it's maybe not so overweight to those large companies.
Yep. Which our approach would not exclude those, obviously. And I think we've talked about that before. We've talked more in detail about the Magnificent Seven. And
Mm-hmm.
I think in our last quarterly discussion like this, we talked about how there had been that shift away from those being the drivers of
Yeah.
return and the broadening out of performance in the S&P 500. And so it's not to say that those aren't parts of client portfolios or a good diversified portfolio. It's just that we try to avoid, right, over concentrating into those large growth
Right.
tech sectors, being a little bit more market weight there, and then emphasizing a little bit more these small cap
Yeah,
stocks and maybe value stocks.
exactly. So small cap stocks make up about 10% of the US stock market. And the way we implement this emphasis is just by overweighting them a little bit. So again, it's, as you said, it's not a whole just going to small caps strategy. We want to get broad market returns, but we also know that, back to your point about price to earnings values and projected next 5-10 year returns, if you're buying a company that has a high price to earnings ratio, the future returns are going to most likely be lower than a company with a lower price to earnings ratio. And so we're just kind of underweighting those companies with high valuations and emphasizing the ones that have perhaps a little lower valuations, and that shows up in the small caps as well. Thank you for joining us for the second quarter update. I hope that you grabbed insight or two from our conversation. If you have any other questions or thoughts that you want to share or reach out to us with, please do so. We're happy to have a conversation with you. Thank you, and hope to see you soon.